Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. It's our pleasure today to host a longtime colleague and friend, Thomas J. Jordan, chairman of the governing board of the Swiss National Bank. I was joking with him a minute ago about him becoming the longest tenured governor of a major central bank. He's not quite there yet compared to some of his peers, but within the year, I think everyone will have retired and he will be on top. Joking aside, Thomas, as many of you have seen in past appearances at the Peterson Institute and elsewhere, is one of the most thoughtful, articulate, principled people we have in the central banking world, which is a very high standard to cross. And I'm very proud that we get to be a venue again for a talk, this time on current challenges to central banks' independence. The reason we were able to get Dr. Jordan back to PIIE on such a broad theme is because of this being the Olcay Lecture on ethics and economics. Many of us, both in person here today and online, knew John Olcay. John was many things, above all a gentleman and a scholar, as they say. John was a friend to me and to many people here at the Peterson Institute, and was particularly involved, as he was with central banks around the world, in giving advice on issues of monetary and financial policy and central bank reserve management. And he was very encouraging of our work. When John unfortunately passed away some years ago, Phoebe Miller Olcay, John's wife, and I, together with a bunch of friends and family of John, arranged to endow this lecture series. I am proud to acknowledge Phoebe Miller Olcay, her daughter, John's daughter, Charlotte Olcay Hoagland, and Charlotte's husband, Nick Hoagland, who are with us again today. This is the first, obviously, Olcay Lecture back in person in some time, and we're particularly grateful to them for being with us today. Just to give you a sense of both the weight we put on this lecture and the heavyweights who have given it previously, the previous 6 lectures include Benjamin Friedman of Harvard on Religion and Rise in Capitalism, Finance for People by Stephen Cicchetti, formerly of the Bank of International Settlements, Making Cyclical Downturns Less Severe by Eric Rosengren, formerly president of the Federal Reserve Bank of Boston, Why After 200 Years Can't Economists Sell Free Trade by Alan Blinder, a visionary talk back in 2017, Sheila Bair on Personal Accountability and Economic Incentives in Ethical Behavior, the former FDIC chair. And the first John Olcay Lecture, John Olcay Lecture, was given by George Akerlof, the Nobel laureate, on Fishing for Fools. The running theme through all these varied topics is this intersection of ethics and economics in practice. How do you take ethical considerations and considerations for the broader public into policy making? And again, I am thrilled that for the 7th lecture, we have Thomas Jordan speaking on central bank independence. Just to recap, Thomas has been chairman of the governing board of the Swiss National Bank since 2012. Just prior to that, he was vice chair since 2010 and has been a member of the SNB's governing board since 2007. He joined the SNB as an economic advisor a decade before that. It's not enough merely to be governor of a central bank. Thomas is also a member of the board of directors of the Bank for International Settlements and the steering committee of the Financial Stability Board, or FSB. He's a governor of the International Monetary Fund for Switzerland, as well as chairman of the G10 Central Bank Counterfeit Deterrence Group. He also has distinguished academic credentials, including his PhD in economics from the University of Bern, and a 3-year postdoc when I first met him when he was at the Department of Economics at Harvard. He was appointed a lecturer and honorary professor at the University of Bern and has received an honorary doctorate from the University of Basel. And today we honor him and our late friend John Olcay by asking Thomas Jordan to give the Olcay Lecture this year. Thank you, Thomas.
Thank you very much, Adam, for this very nice introduction. Dear Olcay family, ladies and gentlemen, I'm very grateful for the opportunity to give this year's John Olcay Lecture on ethics and economics. Well, John Olcay was a remarkable person and a true gentleman. He had an exceptionally thorough understanding of politics, economics, and markets, and was always willing and eager to discuss a broad range of topics. John was also a very good friend of mine and a steadfast supporter of the Swiss National Bank. It is a great honor and a pleasure for me to give this lecture in his memory today. Now, I was scheduled to give this lecture in 2020, but this had to be postponed because of the pandemic. Just 2 years ago, many central banks wanted inflation to notch up closer to their targets, and there were some calls for central banks to directly finance fiscal expenditures. Since then, the political and economic context has changed dramatically. Inflation is far too high, almost everywhere, and central banks are raising their policy interest rates at a time when stocks of government debt are large. In some places, central bank independence is being publicly called into question. Such explicit pressure to curb central bank independence is a fairly recent phenomenon. It was not prevalent in recent decades. On the contrary, there was a firm consensus among economists, politicians, and the general public on the need for central bank independence. This consensus was based not only on theory, but also on practical experience. Price stability can only be achieved with an independent monetary policy, that is, without political pressure on the central bank. In the absence of central bank independence, governments concerned about re-election might try to engineer an expansion in monetary policy in order to temporarily reduce debt financing costs and stimulate economic activity. Over time, this would inevitably lead to high inflation. Without central bank independence, various political groups could also force the central bank to pursue additional goals. This would lead to conflicts of interest and eventually to doubts regarding the ability or willingness of the central bank to ensure price stability. Equally important, given these conflicts of interest, if central banks pursue goals other than price stability, the legitimacy of independence can easily be questioned. This is why independent central banks have been given narrow mandates. In this lecture, I will argue that threats to central banks' independence and thus to their ability to fulfill their monetary policy mandates are ever present and take various forms. While some are obvious, others lurk beneath the surface. Such threats are particularly acute in the current economic environment. Taking a Swiss perspective, I will discuss the pitfalls that must be avoided in order to make certain that monetary policy is set independently and that central banks have the freedom to pursue policies that ensure price stability in the medium to long term. I will begin by discussing the need to delimit central banks' actions relative to fiscal policy. Monetary and fiscal authorities typically take their decisions separately without coordinating between one another. This is for good reason. History teaches us that when central banks are closely tied to the fiscal authority, Expansion in monetary policy is often used directly or indirectly to finance government deficits. Time and again, this has ended in high inflation. High inflation is undesirable for lots of reasons. It reduces consumer purchasing power and it hits low-income households particularly hard. Moreover, inflation causes price distortions that lead to the misallocation of resources and therefore inefficiency. Since higher inflation also tends to go hand in hand with more volatile inflation, it causes investment uncertainty and raises risk premia. Furthermore, reducing high inflation can be very costly. For all these reasons, it is the mandate of central banks to ensure price stability. This typically also includes supporting economic activity. In Switzerland, the central bank has been entrusted with ensuring price stability while taking due account of economic developments. Our mandate is thus limited to the essential contribution a central bank can make to society. Furthermore, the independence of the Swiss National Bank is guaranteed by the Constitution. Safeguarding independence is crucial for central banks to be able to fulfill their mandate. If the public suspects that monetary authorities are making decisions with the objective of propping up government finances, it will anticipate that this will result in higher inflation. As such expectations have a major effect on actual inflation through wage bargaining and price setting, inflation can quickly get out of control. It is thus important to avoid even the appearance that fiscal considerations may be dominating monetary policy. Nevertheless, it is also important to note that independent central banks cannot ignore defects of fiscal policy when setting monetary policy in accordance with their mandate. Fiscal policy can impact on growth, inflation, interest rates, and risk premia. Accounting for these effects of fiscal policy on the macroeconomy and monetary conditions is part of sensible monetary policy that aims to maintain price stability. Let me now briefly address the exceptional monetary and fiscal legacy since the global financial crisis and the challenges that this legacy poses to central bank independence today. After the onset of the global financial crisis, many central banks decreased their policy interest rates to very low levels and even into negative territory in countries such as Switzerland. They also brought down longer-term interest rates by buying government and corporate bonds. This increased central banks' balance sheets and the risk they bear. 2 years ago, measures taken to contain the spread of the coronavirus pandemic strongly restricted business activity. Fiscal and monetary policies responded forcefully via social benefit schemes and stimulus packages. Fiscal authorities helped stabilize the economy. Unprecedented fiscal stimulus led to a substantial rise in already high public debt in many countries. Via liquidity provision, central banks ensured that the markets continue to function, and with loose monetary policy, they aim to stabilize economic activity and avoid deflation. Moreover, an efficient response to this very unusual economic crisis required and warranted cooperation between monetary and fiscal policy. Monetary and fiscal authorities adopted coordinated policies to avoid a credit crunch that could have brought a wave of bankruptcies and massive unemployment. Many businesses were particularly hard hit by the restrictions which governments imposed to contain the spread of infection. The aim of the coordinated policies was to allow these businesses to obtain funding quickly and at favorable terms. It was crucial that illiquidity did not turn into insolvency. In Switzerland, for instance, a joint program combining measures by the federal government, the Swiss National Bank, and the private sector was set up to bridge firms' liquidity shortfalls. As a result of this effective program, within a few weeks, a fifth of all Swiss firms had obtained loans to handle the liquidity shortfall caused by the pandemic. During the coronavirus pandemic, such coordinated efforts between fiscal and monetary authorities were necessary. And they were also easy to align because fiscal and monetary policy had to move in the same expansionary direction. But central banks must now signal very clearly that this coordination was not a first step towards letting fiscal needs dominate monetary policy. This is important for two reasons. First, such cooperation should always be limited, both in time as well to exceptional circumstances. It should not be confused with central banks giving up their independence. And second, the geopolitical and economic environment has now changed drastically. While the pandemic initially reduced both activity and inflation, multiple factors such as supply bottlenecks, pent-up demand, as well as the monetary and fiscal stimulus soon began putting upward pressures on prices. The sharp increase in energy prices, driven in part by the war in Ukraine, has pushed up prices further, while at the same time slowing growth. Monetary policy has now to be tightened in an environment of high government debt. The principle that central banks should not let fiscal needs dominate monetary policy has always held true. But in the current environment, characterized by high inflation and slowing activity, as well as with the legacy of high government debt and large central bank balance sheets, sticking to this principle is particularly challenging. I will now set out two kinds of fiscal dominance, which I will refer to as misused and misguided monetary policy. Misused monetary policy consists of the central bank explicitly deciding to help government finances and reflects a lack of good and stable governance. Misguided monetary policy occurs when central banks' judgment is altered to avoid political pressure, which leads to policy mistakes that help government finances. Let me start with misused monetary policy, which can take two forms, one obvious and one more subtle. The obvious form of fiscal dominance would be for the central bank to be pressured to directly finance the government. It could be asked to directly buy the country's public debt, which essentially means printing money to finance the government's expenditures. Or it could even more blatantly give the money as a present to the detriment of its own equity. Most central bank laws forbid such direct financing, however. Nevertheless, during the coronavirus crisis, some economists advocated direct monetary financing of fiscal expenditure. Typically, these proposals involved a one-off payment tied to specific government spending, such as coronavirus-related economic costs. But this is a slippery slope. If monetary policy is used to finance one fiscal purpose, there will be soon another worthy idea and one thereafter. In the end, monetary policy will be unable to concentrate on its price stability mandate. Allow me briefly to mention two important issues in this context: asset purchase programs and profit distribution. In recent years, many central banks bought government debt as a way of easing monetary conditions. The purchases were directly linked to central banks' mandates and designed to lower longer-term interest rates for the whole economy. The purpose of these purchases was not to support government financing and therefore did not constitute monetary financing in disguise. Central bank profit distribution does not represent monetary financing in disguise either. These profits stem from the monopoly of creating central bank money. Central banks usually retain a part of the profits they generate to build up their own capital and then transfer the remainder to the government. Like asset purchase programs, profit distribution is not dictated by government finances. Of course, there is always a risk of political pressure resulting in asset purchase programs or profit transfers being too big, thus leading to higher inflation over time. But let me come back to the risk of monetary policy being misused for fiscal purposes. In addition to direct pressure on central banks to finance government spending, a second and more subtle form of misuse policy exists. It occurs if central banks are pressured or even told not to increase interest rates or not to sell assets as much or as fast as needed to fight inflation in order to help government finances. A weaker than necessary monetary policy response can cause higher than expected inflation, which reduces the real value of government debt. In the current situation, central banks could be asked to delay or limit raising interest rates. This would keep the government's debt financing costs low. At the same time, it would limit the losses of the central bank's long-term maturity assets and thus keep profit distribution to the government artificially higher. While direct government financing would mean openly breaking the law, this indirect financing by means of deliberately adopting an overly expansionary monetary policy and tolerating increased inflation would only result in the central bank failing to achieve its mandate. Now, fiscal dominance is, however, not limited to directly misused monetary policy. This brings me to the second pitfall that can compromise central bank independence: misguided monetary policy. This risk arises within the central bank and is much harder to detect. Determining the appropriate monetary policy stance has never been easy. In recent years, global crises and structural changes have led to substantial uncertainty in the macroeconomic outlook. For example, the equilibrium real rate of interest and the output gap are difficult to determine. The effects of structural trends such as globalization on inflation are hard to assess. Failure to appropriately account for higher equilibrium real interest rates, lower potential output, or deglobalization could lead to an overly expansionary monetary policy and higher inflation. Central bank staff try to capture structural changes in their models to formulate their recommendation to policymakers. Monetary policy decisions are then taken based on available evidence while taking into account model uncertainty. However, limited information and knowledge allow for wide room to maneuver. In the current environment, a bias towards a slightly expansionary monetary policy option can therefore result from political pressure, as the uncertainty can justify a decision that happens to help government finances. Potential political pressure can tilt monetary policy recommendations towards an expansionary bias through different channels. Let me give three examples. First, central banks may lean towards the conclusion that more expansionary monetary policy is needed when interpreting their own analysis, simply because they want to avoid political pressure in the short run. The implicit hope is that as the central bank postpones the tightening of monetary policy, the government finances issues disappear before inflation increases. Second, at the current juncture, it is difficult to identify to what extent inflation is persistent and to what extent it is transitory. Our own surveys show that Swiss firms are now able to pass on higher input prices to customers more easily than before, and workers' wage bargaining power is rising. Such structural changes, together with the fact that the monetary expansion and the fiscal stimuli from the past feed into inflation with a lag, might cause an underestimation of the persistence of inflation. As a result, central banks might respond less than they should to the observed inflation increase. They may tighten policy too slowly in order to avoid the risk of an economic slowdown and thereby putting the government in a more difficult position. Third, there is uncertainty regarding the timing and size of the price increasing effects of deglobalization. Policymakers might have a bias in attributing too much of the observed inflation increase to a one-time adjustment effects in international supply chains and therefore avoid tightening policies and curbing demand. Of course, that would again help government finances in the short term. Detecting misguided policy is much harder than detecting misused policy. Central banks' actions are taken amid high uncertainty, and there are major debates over whether structural changes are happening and how monetary policy has to respond to them. Given the transmission lag of monetary policy, the true considerations behind accommodative biases can go undetected for a long time. And as there are several structural changes taking place at the same time, any hidden influence of fiscal dominance might never be identified. So, where do we stand today? The misuse of monetary policy with the purpose of financing the government is becoming a real risk. Central banks have started tightening monetary policy in order to bring inflation back down and are thus focusing on their mandates. But further tightening may not be met with enthusiasm from parts of society. With rising debt servicing cost, political pressure to postpone, slow down, or limit the tightening could arise. Moreover, as inflation is persistent and higher than central banks' targets, central banks are politically more vulnerable. In some instances, politicians have already started publicly questioning central bank independence. That pressure alone could make central banks more willing to help governments in order to avoid changes to their own institutional arrangements and mandates. What about the risk of misguided policy? That is, an expansion in monetary policy bias in the current environment. With higher government debt, structural economic uncertainty, this risk has also increased. Trying to avoid political criticism might affect central banks' judgment in the current economic situation. And this situation is tricky. To fight inflation effectively, central banks need independence precisely at the time when such independence is at risk because of high inflation. This leads me to ask one final question. How can independence best be ensured? My answer has three elements. First of all, the dividing line between monetary and fiscal policy must remain clear. Central banks have to make sure that the cooperation between monetary and fiscal policy that was necessary during the pandemic is not perceived as a first step to fiscal dominance. Even though optimal policy coordination suggests a better macroeconomic outcome in some theoretical models, where a central planner acts in the best interest of the country, central banks should stick to the principle of no coordination. For politicians facing elections, the temptation of monetary financing can simply be too large. A clear dividing line between monetary and fiscal policy is best achieved when central banks have a narrow mandate, focusing on their core task, ensuring medium-term price stability. There is currently a tendency towards broadening central banks' mandates with goals such as tackling climate change or inequality. In Switzerland, there is an idea of financing the pension system with the profits generated by the Swiss National Bank. But the responsibility for these tasks plainly lies with the government. Including such additional goals would lead to implicit coordination between monetary and fiscal policy and increase the risk of fiscal dominance. The second element to ensure central bank independence is to prevent monetary policy from being misused for government finances. Financial conditions should now be tightened with a clear focus on bringing inflation back to target. Fulfilling its mandate is the purpose of a central bank, its raison d'etre. With a return to price stability, central banks will be less vulnerable as they can then no longer be blamed for failing to achieve their mandate. The third element to defend central bank independence is to make sure that monetary policy is not misguided and thus avoids an underlying expansionary bias. Central banks should be self-critical in their economic analysis. They must always be aware of the political convenience of erring on the side of caution in tightening monetary policy. But the focus has to be on the available data and on the central bank mandate. When new information changes the picture, central banks must adjust their assessment, adapt their policy, and communicate this clearly. By doing their job well, central banks prove that they are using their independence in the best interest of society. With this, ladies and gentlemen, let me conclude. Risks to central bank independence are real and present around the globe, also in Switzerland. It is crucial for central banks to be independent, not for independence own sake, but as a means of fulfilling their mandate and serving society as a whole. Independence must be defended, and central banks must prove themselves worthy of the independence and the trust that they have been given. Thank you very much for your attention. Thank you.
Whoops, there we go. Thank you very much, Thomas. A highly appropriate and, though calmly presented, quite passionate 7th John Olcay Lecture on ethics and economics. If I could, I'd like to pose a couple questions for you to expand a bit on your remarks. Starting off, one of the things which you picked up on was, you put it in terms of mandates, I would have called it mission creep, the idea that central banks need to be involved in climate change or other things. How does that extend to financial supervision? A lot of central banks have some or all of bank supervision inside their remit. Even those that do not oftentimes have an informal role in bank supervision. Is that an incursion on the central bank independence as well? Are there things you should do to manage the crossover between those two issues, or is that not an issue?
I believe microphone working.
No, so pick up the button. Is it green?
It's red.
Then press the button, please. It's green.
Okay. No, it's great. It's much better. Huh?
Yeah.
Okay. I think it's a very important question, and it depends a little bit from country to country which tradition you have. And what kind of system ensures that monetary policy can really remain independent. So in Switzerland, we had this long tradition that banking supervision is separate from the Swiss National Bank. I'm a believer in that concept where we can really separate that. Of course, we are the lender of last resort. We are providing liquidity, but there's a financial market supervisory authority, which is then the supervisor of banks. And of course, you have other countries where the tradition is very, very different. As long as the safeguards are in place that you can really shield monetary policy from that influence, I think it's also okay, but you have to be aware that there are also, of course, pressure coming from such a construct.
I mean, just to push you a little further on this. So I had the opportunity to serve some years at the Bank of England, and prior to my joining the MPC, the global financial crisis, the bank had deliberately spun out much of its bank supervision to a different authority. Stanley Fischer, who many of us think of as sort of the dean of contemporary central bankers, had warned the then governor Mervyn King and other people, don't spin out the bank supervision because you're just going to have to take it back when something goes wrong, which is essentially what happened in 2008-9. Again, I'm not saying that's inevitable, but you know, in Switzerland, you have two globally systemically important financial institutions, maybe more. I know of two. So when you talk about safeguards, what do you have in mind to keep the fates of these large financial institutions from interfering with monetary policy?
I believe it's really important that you decide on monetary policy with respect to price stability, so that you do not take decisions regarding to interest rate, to liquidity, etc. in general, that may harm your ambition to achieve price stability. And I think you can achieve that in a system like we have that in Switzerland, but of course also with others. It's really, it depends on how you can make sure that you have enough room of maneuver to focus on your price stability target. And it really, I think tradition plays an important role. If you have this kind of mandate for a very long time and you find that the appropriate arrangements that you can make sure that it's working properly, I do not have anything against that. We have just an opposite or just a different tradition where we split this function, banking supervision, from the central bank with a clear mandate of price stability for a very long time.
Thank you. Let me now ask you a little bit more about back to the mission creep idea. A number of central bankers I have heard speak, including some on this stage, have argued if the democratic process is not dealing with a really overt threat like climate change, or I hear this more from emerging and lower middle income economies, but complete fiscal irresponsibility. Is there any point at which the central bank has to step in if people are not getting their job done? I mean, we've even heard from the US Congress at times, we wish you'd raise interest rates so we'd be forced to be more fiscally responsible than we actually are. So you emphasize the not giving into being too generous. What about the idea that you may need to force things in certain areas?
Well, for me, this is a very dangerous argument, a very dangerous line of arguments, because we have a parliament, we have a government, and we have an independent central bank. And when you argue that because they do not their job properly, we can do something in a certain direction, I think this is very dangerous, and it could be also the end of independence. As soon as the parliament finds out that this is mission creep and the central banks pursues goals that may be not exactly the same as the parliament, or where they are inactive, that could really backlash, and I think this is a very dangerous path to go. So independence is really legitimized by the fact that it's focused narrowly on price stability, but it's not here to do everything. So if you misuse this independence to do actions that are reserved really for the parliament and the government, I think over time that will create a very difficult situation.
You mentioned in passing during your talk the idea of what the profits a central bank makes as part of its monetary policy activities, how they get distributed or how they get used. And this is, again, something general, not specific to the Swiss National Bank. In the US, the Federal Reserve at times has been taken to task for supposedly not turning over enough profit. But at other times, of course, central banks make losses on part of their portfolio for monetary activities. How do you think this should be structured? Do central bank balance sheets or central bank capital, more accurately, really matter? Do you need some kind of explicit agreement with the government? How do you manage this issue of where the profits go?
Well, I can mainly speak again for the Swiss situation. So I believe we should have enough capital to absorb losses. So that means that we have to be prudent when we are giving money to the government. And we have a very volatile profit and loss situation from one year to the other. So a big profit in one year is often followed by a big loss in the following years. So by just giving this money to the government, we may have then a hole in our balance sheet. So we have to be very careful. So we have a concept of smoothing profits over time, smoothing the payoffs of these profits. And this is a very good concept. But of course, now we had a couple of years where we had big profits, and now we have a terrible year this year with increasing interest rates, the stock market declining, and the Swiss franc appreciating, and that creates heavy losses. So we are really fortunate that we did not pay out all the profits in the past, so that we can absorb now these losses. And I think this is very important that politicians or the public in general understands that there is a certain volatility in these profits. And when you always transfer all the profits, you may then run into difficulties in years where you have the losses.
Thank you. Let me go back. It's going to sound like something of a repeat of a previous question, but I think this is a critical issue we want to go back to, and then I'll open it up to the audience for questions. Just a reminder, as we are video streaming live throughout the world, this is completely on the record. Thanks to Thomas and the Swiss National Bank for doing that. A term that we're used to hearing the term fiscal dominance, but a new term has come up, or maybe it's not so new, but it's new to me, is financial dominance. And without asking you to comment on other central banks' business, we're arguably seeing an instance of that with the UK right now, where the particular structures and foibles of the UK pension system have meant that the central bank essentially had to intervene to keep the gilt market, their long bond market, functioning. Is this something that you put under your heading of central bank independence, that you're trying to avoid having your hand forced by markets in some sense? Or is this just part of life and it's really wrong to put it in the same category as like fiscal dominance? It's not your two terms, it's not one of your two kinds of mistakes.
I will not put it into the same category as fiscal dominance. It's something, in my view, which is different. So we had to react to the pandemic. We had to react to the great financial crisis, to other recessions, etc. So this is part of what we have to react. It may be unfortunate because it was triggered by certain decisions, but nevertheless, we have to take into account the economic situation, the situation in the financial markets, and then to take the appropriate decisions in order to maintain economic stability and price stability. So what I said before, we have to take into account decisions by the government that have an impact on growth, interest rates, etc. This is not fiscal dominance. This is just sensible monetary policy. Fiscal dominance is really something different, where the the policy of the government has a direct, not only an impact, but a direct say on what central banks actually do. And this is, in my view, it's very dangerous.
Thank you for clarifying that distinction. I know that Joe Gagnon has a question on independence, but I also see Patrick Honohan, formerly one of your colleagues in the central banking fraternity sorority group. Patrick, please.
Thank you very much for an interesting talk. My question is about unconventional monetary policy. Central banks, including the Swiss National Bank, over the past decade or so have used a wider range of measures than had been customary in the previous, let's say, 20 years. And I'm wondering whether there's an important link between this and the threats to independence of central banks. There were a lot of complaints, for example, all around the world when central banks used QE to keep long-term interest rates low and therefore drove up the value of assets and seemed to change the distribution of wealth. Now, one can discuss whether they did or not, but it created a political environment. And also intervening in particular financial stress situations where everybody's having difficult times, but financial firms got bailed out because if they weren't bailed out, bad things, worse things would happen. That also creates a sense of, a political sense that there are winners and losers in this game and that the central banking decisions are at the heart of that. Do you see that sort of narrative, political narrative, as generating a political threat to independence? Because at the end of the day, the general public, the voters, will influence what governments want to put into parliament and legislation.
Well, Patrick, you are completely right that many of our actions in the past had a big influence on valuation of assets. There was this big debate whether wealthy people became even richer. At the same time, it was always the argument that by doing this expansion monetary policy or pursuing this expansion monetary policy, we're helping everybody to remain in the labor market. So my perspective is that we should not really have that in the focus, but rather on price stability. And sometimes price stability means that you have to be very expansionary, and that drives up valuations. You cannot do a lot about that. But of course, and then we get into another situation as we are at the moment, where again, price stability needs high interest rates and valuation come down. And I think it's very, I think really key that we focus on the same target over the cycle and not just being expansionary and then say, well, that was very good to have high valuation. And now we fear valuations are coming down and that is harming some groups. So we have to keep interest rates down. I think this is very important that the focus, the mandate remains very clear. And then sometimes you have, as a side effect, you benefit this group, and then in the second part of the cycle, you benefit maybe the other group. So this is something that are, in a way, side effects that you should not really account or taken into account too much, but really focus on the medium to long-term price stability. But you are completely right. I think there is a big debate who profited from this policy, and you can, of course, use the argument in all kinds of directions. So I believe it is very dangerous for central banks to use certain arguments that we did this expansion monetary policy, especially for this group or the other. It's always here to maintain price stability, and that incorporates, I think, the maximum that we can contribute to society, and it includes everything. As soon as we go into more details that it's beneficial for those and not for the others, etc., we go into very, I think, on a slippery slope.
Thank you. Joe, please, Joe Gagnon.
Thank you, Adam. Thomas, you said very clearly that the main focus should be price stability of central banks, and you're worried about errors towards high inflation. What about the opposite case? When central banks have inflation that's below their target? We actually have in the world a few countries where inflation has been below target, sometimes by a significant amount and sometimes for many, many years. How should we think about central bank independence in that circumstance? is it just less of a problem, or do they need more tools, or that's where we need fiscal cooperation? How do you think about that error on the other side?
This is an interesting point. I think we have to avoid deflation. So this is really a big, I think also very costly to society, to the economy. So we should avoid that. But we should also be very sensible to the situation that we have at the moment, where inflation is high. And I think for many groups, especially the low-income group, it creates a very difficult situation. Well, I believe personally that having an inflation rate that is positive but relatively low, and it can even fluctuate between 1 or 2% or even in that area. So this is all compatible with our definition of price stability over the medium to long term is something that is acceptable and I think very good for society. I believe when you argue that, well, a little bit below inflation, so it's 1.8, 1.6, and then you use this kind of deviation for then being extremely expansionary with the risk that later on inflation really picks up. I think this is, in my view, a little bit problematic, and we see it at the moment where we had a long, almost a decade discussion that inflation is really too low, and it was never such a big problem because overall the economy functioned not in a normal way. And now when we have inflation rates that are much higher, between 4 and 10%, something in that area, we see that it's much more costly and it's much more difficult both for the economy but also for certain groups. So I think we should be relatively relaxed about certain fluctuation of inflation at a relatively low level. We should avoid deflation. In Switzerland, we did that by also being really extremely expansionary with our balance sheet. But whether the inflation rate is sometimes a little bit below 2% or sometimes a little bit above 2%, this is not something that changes, I think, welfare dramatically. So we should here have a certain flexibility, be relaxed about these fluctuations, but rather look at the medium to long-term perspective of the inflationary outlook.
Thank you. Another question from the audience, please.
Hi, Steve Kamen, American Enterprise Institute. Thomas, I wanted to follow up on Adam's last question about financial dominance, but I wanted to kind of push it a little further and ask about a particularly fiscal variant of that, which is a government whose debt is growing rapidly and the markets are very worried about it and they're pushing up yields a lot and threatening to, a financial crisis. So clearly it's fiscal that's pushing the yields up. But it threatens crisis. So what is the independent central bank to do in that instance?
Well, Steve, this is the tricky situation, but as I said before, I believe if it's not related to directly financing the government, central banks have to take that into account. So if the fiscal policy is driving interest rates, is also growth, etc., taking that into account in an independent way is part of sensible monetary policy. But when you do that only because you make then the financial situation of the government better, and you could have higher interest rates without really, or by not increasing rates to make the life easier of the government and to accept higher inflation, I think that would be very bad. If you take it into account in a certain economic environment, which makes sense and it leads to the right monetary policy, I think monetary policy should do that. I think this is a fine line, but I think this is the key difference between the two situations. So keeping really or maintaining your focus on price stability, adjusting your policy, given the environment, given the high government debt, is the right thing to do. But not increasing rates and then accepting a higher inflation rate later on, I think that would be the wrong policy.
Is there a final question from the audience? Yes, please. Please identify yourself when given the microphone.
Hello, Isabella Moda from the European Central Bank. What's your opinion about the ongoing debate on the synchronized global tightening, and that central banks who look at their domestic inflation developments and domestic mandates nevertheless act in an environment where also other central banks globally are tightening?
This is an interesting point, and we are discussing that, I think, this week also at the IMF meetings, at the G20 meetings. Of course, central banks have always to look into the future and see whether their tightening cycle is overdone or whether it's just the right one. It's very hard to coordinate this globally, so every central bank is independent and has to look at its own situation. But we should fight inflation, but of course we have to take into account what is the impact now of a possible recession or a global slowdown, or what is the impact of tightening elsewhere on your own situation. So this creates an extremely complex situation where the interpretation of the situation becomes very important and very difficult. But this is the job we have to do. But it's also, of course, a situation where certain mistakes can be made. So I think it will be very important to have a clear view about what is going on in the business cycle, how fast is inflation coming down by itself, how much tightening is necessary, and how much is the price evolution also influenced by policy elsewhere and not only by your own policy. Again, this is extremely complex. We have to do our best, but we cannot change the situation. We have to live with that and to figure out what is the optimal policy under those circumstances. And as I said before, every central bank is responsible for its own jurisdiction and see whether price stability can be achieved in that either in the currency area or in a country.
Anyone else? So, Tomas, we know you have to get back to the business of the week, which is the IMF World Bank annual meetings, the G20, the FSB, and all those things. One last question, if I may. One term which maybe you used, but I don't recall hearing, is this word legitimacy. You've spoken a lot about how the central bank should conduct itself in principle and in practice, and I think we've all benefited from that. But we live in a world where, perhaps less so in Switzerland and the US, but also in Switzerland, institutions are coming under scrutiny, under unfair criticism as well as fair. You know, we didn't talk about today, but we've spoken about Bitcoin and various cryptocurrencies as representing people's desire to get away from state-sponsored money, for example. As part of keeping the central bank independent, what does the central bank need to do besides just simply do a good job? I mean, do you see a role for you to be speaking out as you are today on central bank independence? But that's partly because we asked you. Are there things in the transparency area or political accountability area that you think matter to central bank independence being sustained? Or is it ultimately you deliver what you're supposed to deliver and you'll be left alone?
Well, Adam, a very important question. I think delivering on price stability is absolutely key for central banks. Independence will only survive if there is a positive result for the public at large. So having high inflation for a very long time, that will be a disaster, I believe, for central banks. So delivering on the mandate is absolutely key. I think also explaining the relevance of independence is key, and of course also explaining your policy and being transparent about how do you achieve this goal. So this is all part of this package when you are independent, but without really having a situation where price stability can be maintained over a reasonable time horizon. I think that everything else does not help. So I think we have to deliver. Otherwise, it will be very difficult to see the advantage. And people will ask, why are you independent when you do not achieve your mandate? Of course, there are always situations that where you can explain, well, this deviation is because of energy, of war, etc., where central bank independence does not really help. But over the medium to long term, I think the benefits have to be clearly seen, and otherwise the argument for independence will go away.
Thank you very much. With that, we'll close today's session with deep thanks to Dr. Thomas J. Jordan, Chairman of the Governing Board of the Swiss National Bank, returning to the Peterson Institute to give a lecture on the current challenges to central banks' independence. This has been the 7th annual O. John Olcay Lecture in Ethics and Economics. Thank you for joining us today.